Certainly, I think the market was looking less for optionality and more for guidance. That we would see more of that to come, and what the market got was a more conditioned Powell looking for optionality, the option to go the other way with just 25 basis point cuts.
How then does that shake out in your world, Christian, in private credit markets, and just how benign or otherwise does the outlook? What does the outlook hold for us? And particularly, your thoughts on this new frontier of asset-backed finance?
Yeah. Well, on the one hand, if you get these rate cuts, then it continues a pretty robust backdrop for a lot of credit issuers, where if you have rates coming down, finally, and continuing to come down, maybe a little bit less than the market expected, but still we'll get a series of almost 200 basis points of cuts over the next year plus. So we'll have a very significant path of rate cuts that will help floating rate borrowers, that will come to the rescue of some of the more stressed private credit issuers who've been having to pay these higher rates. And in asset-based finance, it'll be something similar, where a lot of consumer, auto, student loan, other types of receivables that are the new wave of asset-based lending will also benefit from lower rates in the context of an economy which has softened somewhat, but is not seeming to slow down significantly. That's a pretty good environment for...
So, most of the major buyers of private credit, we've seen ultra-high net worth individuals, family offices, et cetera, with the rate cut cycle finally starting now. Do you think they're breathing a sigh of relief?
They are. Of course, the flip side is that you won't be receiving these high nominal rates any longer, but it would be much better for most borrowers, whether it's corporate or personal borrowers, to have lower rates in the context of an okay economy than to have the high rates that we had in the past. So, yeah, returns will be a little lower, but safer.